All right. Good morning, ladies and gentlemen. Welcome to my webinar. Obviously, as you all are aware, what we're discussing, I'm looking forward to it. It's a fine sunny day in Sydney, so I don't have much complaints. It's the weekend tomorrow, so hopefully everyone has a few things to look forward to. But I'll just share my screen so we can get started and we can get the ball rolling. Hopefully you guys can see everything there on your end. But obviously today, what we want to discuss is investing locally, obviously here in the Australian market, compared to the global markets, and how to position yourself and your portfolio for not only growth, but obviously dividends and a really, really good balance. So firstly, my name's Harry Macaskill. I'm one of the senior advisors, head of desk at Sharewise, and I'm also a partner at the firm. So I do want to thank you guys for your time. I know it's a Friday, so you're probably working, couple of people working from home. It is recorded, so if you do sort of have to run, or you join late, I know you're probably not watching it if you're late, but there will be a recording, so you can always go back and double check. My goal is to give you a bit of an insight that you can use, and maybe motivate you to potentially reshuffle your portfolio, to potentially make a few changes, because if the market's moving up and your portfolio isn't, that's still a bit of a silent loss at the end of the day. So the biggest risk isn't being wrong; it's sort of being stuck or doing nothing. So that's typically what I speak to with a lot of my clients. So if you've got any questions, there's going to be a Q&A at the end. So please drop your questions in. I'm excited to go through a few questions, discuss with you all, and hopefully provide a really good insight into what we're doing and how you guys can potentially maximize your results. So just a quick disclaimer, of course, this is all just general advice. It is not personal advice, and nothing in this presentation and what I say should be taken as financial or personal advice. So even our past performance and things I mentioned regarding what we've done in the past doesn't mean we're going to be anywhere closer to doing that in the future, right? All we can do is continue to stick to our strategy. But if I can show you our thematics and what we're looking at, and give you a bit of insight, all I hope to do is to provide a little bit of value. So again, sit tight. I'll try not to blabber on too much about a few things. I'm sure there's a lot of investors out there from all different walks of situations, I should say. A couple of people in here who are retired, some still working, some a lot younger, looking for growth. So the aim is just to try and cover some key points, not going into too much technical, terminology and confuse everyone. It is going to be, a good understanding and just a basic sort of coverage on Australian and US equities. So to get started, why local versus global investing matters more than ever. Well, it's pretty straightforward, right? The world's more connected than ever. We've got AI, we've got technology that's not going away. Investors who limit themselves to one market, well, again, they're going to miss out on opportunities. Like I said, if your portfolio is sort of staying stagnant, you've got the Nasdaq and the S&P going, really, really well. It's still a silent loss. So my job is to take a little bit of weight off your shoulders, not add to it, right? And the world, like I said, globally moves a lot quicker. The US is the biggest economy in the world for a reason. On the other hand, obviously markets like the Australian market offer stability, a little bit of peace of mind and tax benefit, whether it's franking credits. But most importantly, the key is balance. The key is having a balanced portfolio, diversifying, minimizing risk. I think we all know that. So moving forward, just a little bit about the Australian market. It's strong. It is really, really strong at times, but it's also very, very narrow. Now, what I mean by that, as you can see, we're a very, very small piece of the pie. We don't take a large chunk of it. The ASX only represents 2% of global equities. Now, again, a little bit frustrating as Australians, we think we're stronger than that, but unfortunately we're not. We lack exposure to innovation like tech. Australia is such a large landmass, but we don't do much with it. In the US, they created Las Vegas from pretty much a desert, so that's just a clear example of the way that innovation is over there in the US and just the broader markets. So We're dominated by banks, dominated by mining stocks. There's always mergers and acquisitions happening in WA with regards to miners and all across. And we do have a lot of solid healthcare names like the CSL and the likes, but we do, like I said, offer that stability and that tax benefits here in the Aussie market. So again, goes back to what I said. We want to have diversification. We want to have dividends. We want to have income, especially for those that aren't working anymore. They want the income coming through and just that peace of mind at the end of the day. And like I said, we're only 2%, and that's a narrow playing field. But obviously, the world index in 2024, which they stated, the ASX represents, the global equities market for the ASX is slowly and surely increasing year on year, but still in comparison to, well, something like the global markets, the US alone makes up 60%. So, again, it's quite clear, you get access to companies like Apple, Nvidia, Microsoft, right? We go back to just quickly back on the topic of the Australian market. And when I mentioned sort of stability and income, companies like New Hope, NHC, New Hope Corporation, McMillan Shakespeare, WAM Capital. Those are three names that I know pay some of the highest dividends on the Australian market, all around that 11.5% to 13% respectively, gross dividend yield, which again, you can't get that anywhere in other market. So again, that's the strong part of the Australian market. But obviously, there's no point buying dividend stocks if the share price is still going to potentially fall to the wayside. You want to sort of find good dividends and a good potential upside. And you want to see a company that's beating expectations year after year, like we see a lot of the time with companies like Nvidia, Microsoft, Apple. I could go on all day. Over the last 5 years, Nvidia has done, I think it was roughly 2,700%. Nothing like that in the Australian market. Access to the global markets, you get Europe and Asia. They're providing opportunities in luxury, automobiles, semiconductors, green energy, you name it. There's a lot of stocks that we've identified in Europe actually, and the Hang Seng market that are doing really well. And investing globally gives you access to the world's biggest innovations. Which many don't exist on the ASX, or it's very, very hard to find. You'll see some of our big tech stocks, they end up listing on the NASDAQ. Why? Well, trying to get more market share because there's more money. You want to follow the smart money. So again, that's a key area that we're focused on, and investors and clients are sort of seeing the results there in that regard, which is really, really good. Now, just the US alone making up 60% of the global market cap shows why it's important to actually at least have the slightest bit of exposure. The slightest. Like, if you don't have, a Microsoft or an Apple or even a JP Morgan in the world in your portfolio, you're sort of shooting yourself in the foot, is like how I like to explain it. You're not going to go out in the battlefield without a gun. It's as simple as that. So just to run through a few numbers, I did a bit of background check just to make sure that what I'm saying is actually true, for better outperformance and just better diversification. So I've already mentioned Nvidia did 2,700% roughly since 2020, right? Apple roughly 300%. JP Morgan, one of the biggest investment banks in the world, has done roughly 200%. Now, if we go to the Aussie market compared to BHP, well, yes, they do pay a dividend. However, the growth is since roughly 2020, again, depending on where you're sort of doing the charting from, has done roughly 40%. Coles 40%, and CBA has done 100%. So again, you're getting 3, 4, 5 times the results out of some much larger market cap stocks. Nvidia is a $4 trillion market cap. So again, it just shows that having that diversification isn't going to hurt your portfolio. In fact, I think it's just going to add to it. And it's not. Hope isn't a strategy for one. Just hoping that your dividend stock's going to go up. Neither is holding a stock just because. You want to have solid reasonings why. And you can't manage what you don't measure, right? Most people fly blind. We like to sort of make sure we're in the best companies, in the best sectors based on certain metrics we're looking at, right? So what history tells us, again, this is just the index alone. if you sit in the Nasdaq, well, just that alone, you're going to significantly outperform, and it's quite simple. Simple. It's outperformed the Aussie market, but on average, right, since the last 10 years, the Nasdaq has outperformed significantly, an average around 12%. The S&P 12%, versus the ASX 200. 8% per annum for the last 10 years. That's as of pretty much where we are now in the market. So just to put that into a bit of a case study as well, on $500,000 investment 10 years ago, and you don't allocate any more towards that, that extra 4% a year totals to be $250,000, which is a substantial amount of money. Clients we work with, $500,000, that's a pretty, it's a pretty casual start, goes all the way up and also goes all the way down. Doesn't really matter. But just to give you guys a perspective, what 4%, sorry, over 10 years can actually do for your portfolio. And that's just by giving you a little bit of exposure potentially to the US market. And again, not only that, you get a little bit of currency diversification and you get diversification in key sectors, which is incredibly important, right? You've got participation in higher growth economies. Again, the Chinese economy is absolutely flying at the moment. They're continuing to pump their economy to obviously get themselves out of the hole they've been in for a few years, and it looks like that's on the way. But again, Trump has different ideas with tariffs. However, we're seeing in the Indian economy absolutely take off as well over the last 3-4 years as well. Again, now Trump's throwing a bit of a spanner in the works there with tariffs. But you also get access to mega trends like AI, clean energy, and the biotech sector in the US is significantly larger in the US. And again, you'll see companies that are listed on the ASX that are doing well in the biotech space. And more often than not, they're trying to get listed on the Nasdaq or get exposure into the US market. It happens so many times, and it just goes to show that those managing directors, those CEOs know that's where you want to be, and the places to get just a better result at the end of the day and more money. So the way I look at it, it's not just smart to have global diversification, but it's just necessary in today's market. Obviously, like I said, to potentially get a higher yield. Again, there's a lot more volatility. You see some stocks that do drop pretty quickly and quite heavily, but it's all about minimizing your risk. You got to have key measures to minimize your risk, and that way no one's going to get 100% hit rate. You, me, anyone else out there, Warren Buffett, no one is going to get 100% right. So it's up to you as an investor to actually manage your risk, and that's the key to outperforming in our eyes. But obviously, you're not going to transfer. Let's say you got a $5 million portfolio in the Aussie market. You're not going to switch it all to the US, right? Especially not overnight. Why you'd stay local? It's pretty straightforward. We've blended it. So we've spoken about it already. I've gone through it. But frank dividends. You've got tax advantages, effective income. You've got more local knowledge and obviously understanding of regulation here. Peace of mind. That's a big thing, right? People want to be able to sleep at night. People want to know where their money is, why it's there, who's behind it. A lot of people with mining stocks, they want to know who the management team is. And it's a lot easier to get access to information, right? So that's why you want to stay local. You've got stability from major banks and a stronger regulatory system. Australia is one of the most regulated countries in the world. And franking credits, like I said, they can boost after-tax income. And obviously that's very, very beneficial for super funds and retirees. So again, there's plenty of reasons why I should be in both. And there's a lot of pros and there's some cons to both. And again, if you've got questions, more than happy to answer a few of those and go through. But how I look to build a bit of a balanced portfolio, what we call it is a bit of a core satellite approach, core satellite model. And again, your core, you want to have your ASX blue chips for your income. So, your BHBs of the world, your Woodsides of the world, potentially, obviously, given the trends, I know BHB wasn't something we were holding whilst China was going through a big slowdown and iron ore prices were sort of getting beaten down, and same thing with oil. it's all about timing, but we all know these household names: Woolworths, Coles. Again, these are just names; these aren't necessarily stocks we're holding. But then the satellite approach is for global growth, trends, and thematics. The thematics at the moment, which I'll go into more detail, it's AI, it's quantum computing, it's semiconductors. That's where all the money and hundreds of billions of dollars is being thrown out by governments around the world to make not only their economies more efficient, but every company out there. If you're a business owner listening, what do you want? You want to fill in efficiencies. How are you going to do that half the time? Well, it's hard to find the right people, so AI is replacing that, and things that that used to take 2, 3, 4 hours can be done in 30 minutes, if that less, right? So that's the trend. And for myself, I consider each client's risk profile. That's a necessity, their goals, their timeline, and to yield a result they're happy with on the basis that we're working together and it's not a one-man team on my own, because it's more of a partnership. So you want a potential blend of ETFs, and I'll explain a few things what we do in the US to get exposure to leveraged ETFs, 2x leveraged ETFs in companies like Nvidia, like Apple, like Google, for example, that you can lower your allocation size rather than doing, let's say, a $50,000 position. You can do 25, 30, 35,000 to get basically the same exposure, same upside, but less risk. Not only that, you've got more cash that you would have had to have put in to make it a feasible allocation that you can then use to that core satellite approach and invest in those blue chip and income stocks. So that's that's a thematic we're doing. Well, that's an approach we're doing and positioning clients this quarter. And then obviously strategic thematics, which is pretty straightforward. And the global themes, like I said, AI, semiconductors. Why is China trying to take over Taiwan, and why there's so many tensions there? Well, as we know, it's all about semiconductors. Nvidia, AMD, TSMC, clean energy. You're looking at Tesla. You're looking at an ETF. You're looking at ICLN. These stocks, you can take a photo of their screen. You can look at them for yourselves. And defense. Obviously, we know that's been going absolutely through the roof. Lockheed Martin, Northrop as well. And then on the healthcare side of things, Eli Lilly and Novo Nordisk. So, these are hard or impossible. These sort of companies with the size and the potential upside, they're very, very hard to access or close to impossible to access on the ASX. The only sort of things I can think of, when it comes to clean energy on the ASX, it has some really good upside, is Vulcan, which is one of the only net zero carbon lithium producers in the world, close enough. It's VUL. In the AI space, I couldn't name anything anywhere close to Nvidia, and they've got so much market share. Nvidia and AMD, you wouldn't even look at the Australian market for that. And then healthcare, we've got some pretty big up and comers, but again, it's always tough to try and get into that industry on the ASX. Now, the risk to manage, however, when going global, if you're not global, I'm sure there's some that are finding it hard or absolutely killing it. And I hope there's more killing it than not. Or there's some that are probably completely new to this and they're not sure. So there's obviously time zones and trading access. There's a little bit of difficulty there. If you're trying to get an order in and you're not awake, I think at the moment, based on time zones, the US market opens at 11:30 p.m. So I'm, the team, myself, are up at certain times doing what we need to do to make sure trades are being executed at prices that are important. So that's one thing you have to consider, of course. You've got political and regulatory uncertainty in emerging markets. Now with tariffs, yes, Trump is creating a lot of uncertainty. However, what he's doing is clearly, showing that, it's potentially for the better of the economy. But who knows? We'll see. We're at all-time highs. Yes, there was volatility when he was showing tariffs out there left, right, and center. But again, the market's recovered significantly and very, very quickly. And everyone listening, you wouldn't be on this Zoom if you didn't take your investments seriously. So these are things you all want to consider. And obviously, you don't want to chase the risk of AI and quantum computing without a plan. You might get one wrong. What do? You need to have that plan. If not, you could potentially be down 50, 60% very, very quickly on stocks that you thought, oh, well, there's a trend, there's money going through it. But again, it's all psychological. Market's all what someone wants to pay for something, and there's inefficiencies in the market, and they're always going to be filled. And what do we look to do? Well, it's pretty straightforward. We help help clients manage and mitigate these risks to get a better result. And that's as simple as it is, right? So it opens the door to growth, right? You need a guide to avoid, missing opportunities, and you need a guide to make sure you're not jumping the gun, right? It's like, I consider myself like a GPS in a car. Yeah, you could get there yourself, could get there, but I'll help you not get lost. Or Sharewise can help you not get lost, and we'll help you get there quicker, right? We'll fill up the tank. We'll change your tires, but you're the driving. You're the driver. You decide how quickly you want to go, how slow you want to go, whatever it might be. Okay. Now, again, how I help: a clear strategic investment approach based on your goals, appetite, time frame. I've already mentioned that. I don't want to repeat myself. But the most important thing is rebalancing of what you've already got. You've already got $1 million in the market. You've got another $700,000 cash. Let's not even talk about the 700,000 before what you've got is working. It's efficient, not inefficient. And then we can consider looking at the US market, redeploying any cash. But what you've got needs to be working harder and more effectively before you talk about any new capital, new positions, right? Access, well, what we give clients access to IPOs, research, professional insight. I think it just comes down to discipline, right? Every successful businessman, sportsman, you name it, they have discipline, right? Every CEO is a disciplined businessman. His schedule is in 15-minute increments. You look at a CEO of a major company like JP Morgan, he wouldn't have 10, 15, 20 minutes spare on a daily basis. That's because they're disciplined, they know what they need to do, and they know how to make decisions, right? So that's what we look to do here. And yeah, you could do it yourself hypothetically, but there's a reason barbers exist. You can cut your own hair. I could certainly cut my own hair. I don't think it'd come out very well. So it's about being more efficient, getting things done effectively, having a portfolio that is in the right stocks at the right time. Again, we can't provide guarantees, but what we're trying to do is minimize risk and yield the best result given certain scenarios. I bring over 5 years of experience in the stock markets. Now, the beauty of Sharewise, it's not just me, right? There's the CEO, the chief investment officers, the whole institutional grade research team that come up with ideas. I just help clients get through all the information, the emotion, and focus on actually what's moving and what's actually working. We combine our macroeconomic views, the fundamentals of the businesses, and come up with investment opportunities at precise times. And I'm not going to sit here and say, I'm actually not going to take any credit for what goes on at Sharewise, because if it wasn't for them, we wouldn't be here as a team, and I wouldn't be sitting here right now. But as a partner of the firm, I can say that I'm very, very confident in the team we've got, and the team we're continuing to build. That's giving us a strong understanding of both Australian and global markets on a continued, week in, week out basis, right? I would say we're very disciplined with a risk management approach, which is, again, like I say, probably the most important thing. And we've got a hit rate of 70%. Now, let's say we get 3 wrong out of 10. Well, what's the point? It doesn't matter how many get you right. If you're down 70, 80% on those 3 stocks, you've just lost every bit of money you've made on the other 7. So from my perspective, if you're looking for someone to guide you, with great and quality communication and a solid plan, I'd love to have a conversation with you. From my perspective, I'm more than happy to have a one-on-one portfolio review. Now, it doesn't have to be a portfolio review, just a conversation. We can look at what you're looking for, see what is going on, and potentially have a look at what you've got planned moving forward. If there's any issues you're having, what you could think is working, what isn't working. But I do thank you for your time. It's actually it's been a good little breakdown of what we're doing, and just even if we don't have a conversation after this, I hope you've taken a few things from this to get an idea of what you want to do moving forward. But again, thanks for your time. Are there any questions anyone has that they want to go through? Drop them in the chat, and I can go through a few questions with you all. There has been a few coming through, so let me get them up. Bear with me. Okay, someone's asked, what's the difference and what's the benefits of investing in high yield income ETFs versus AI and defense ETF options at the moment? So it's a good question, because again, you want to weigh up, and sort of getting in the AI and defense space would be more so you going, the companies in that ETF are certainly going to be companies like AMD, Nvidia, and the likes of some of the other ones I mentioned. But the income and the benefit of the high yield income ETFs, including franking credits on the ASX, it's pretty self-explanatory. Tax benefits, you've got lower volatility, more predictable. They're very favorable for those investors that have a bit of a buy and hold strategy, and you don't really want to have to think about it or look at it very much, which is very, very advantageous. Again, if you've got the idea that you want to dividend reinvest, something like that is probably going to be more beneficial. In terms of what sort of ETF you'd be looking at in that regard, there's MSTY. I know that's a JP Morgan ETF from memory. There's JEPQ, which is another JP Morgan ETF, which pays monthly dividends. And I'm not sure how frank they are. AI and defense ETFs, well, again, it's a no-brainer. There's gonna be higher upside, increased volatility, however. But I'm not sure about the dividends in those regards. Obviously, it depends on the ETF you end up picking to go with, but it's growth focused, it's higher risk appetite, and you're most likely going to yield a better result, and moving forward. So it's one of those things where you've got to weigh up your goals. If steady income and tax is your priority, or if you want growth and you want have that thematic around moving forward, that'd be excellent. What else is coming through here? Okay. Someone's asked, is the financial sector a good investment over the next 12 months? Look, I mean, the banks are certainly showing resilient earnings amid economic uncertainty, for sure. And the evaluations I would consider stretched slightly. Like you look at CBA, where it is sort of its reach around 6 months ago, wouldn't have thought it'd be anywhere near that. But future performance will depend on interest rates, obviously coming from the RBA, and that the RBA is going to make a decision based on what the Fed does over in the US, the Fed Jerome Powell. But policy reforms like encouraging competition through the CBOE, and easing of regulations in smaller banks could reshape the regional bank landscape, potentially improving companies like the Bank of Queensland, which has been sort of defeated and beaten down recently. But the bottom line is that the banks are always going to be stable. If rates cut, there's going to be potential upside, but evaluated valuations will obviously be put out by the institutions. But again, a balanced approach. If you've got exposure to the banks, you can't really go wrong if you pick one of the good four. So again, good question coming through there. There's a few things coming through from franking credits, and I don't want to get into too much detail regarding tax advice and how that all works. But franking credits are one of those things where, in theory, they can deliver a real net benefit, especially for shareholders whose personal rates are below the company rate. And again, there's a lot more detail than it just being franked versus unfranked, considering how the investor is invest and everything like that. But the best part about franking credits is it bypasses the corporate tax and the double taxation that's going to be happening if there's no sort of franking credits being put through. So that's all I've got for now. Again, I'm very, very happy and thankful that everyone has come to listen and come to watch. Scan the QR code. I'll give that another minute or so. If anyone does want to book in a free consultation, a bit of a conversation, and I'll be sure to reach out, and I'm sure you've got a few more questions that you might want to just ask me individually rather than on the Zoom meeting here. But everyone, enjoy the weekend. It's been a pleasure. Again, my name's Harry Macaskill, and I'm, like I said, one of the senior investment managers and a partner of the firm. And I look forward to having a conversation with many of you moving forward.